Hello, Equipedians. Hope you all are doing really good. So, we are done with 3 study sessions now, and we start with the fourth one today. The absolute valuation models, we have done the free cash flow approach, we have done the uh, dividend discount model. I like the work of most of you on dividend discount model, and so you understand the basic difference between absolute valuation and relative valuation. Practically, relative valuation is also very important. It's very important because how good a stock is priced, how well a stock is priced, I can only figure out if I am comparing the stock with other stocks belonging to the same sector. Okay, that is very important. So the advantage of relative valuation is that it is short, crisp, to the point. The disadvantage is that there are different ways in which relative valuation can be done, and none of them can be called a complete measure in itself. Like I'm saying, you know what exactly the idea is. The whole idea is, if there are, so basically during this studies, during this entire Equipedia course, we'll teach you so many different parameters of looking at stocks. People often ask me how we are able to be so accurate about our research work, or how we are able to give buy recommendations with 95% times the recommendations going bang on. We are able to make money for the clients. I say very confidently that it is the sheer hard work that we put in. Now, when I say sheer hard work, it is like I don't go by one particular measure for evaluating a stock. Right now, you are not realizing, but even you, I am preparing the same way. I'm teaching you different methods of doing the evaluation, and then comes a point where I will tell you to literally use all these methods in each and every pick of yours, and you'll see you will become so good at picking up stocks. Yeah, that will be time consuming, but as an investor, we don't mind putting in a lot of time and making a buy, which over a period of time will fetch me good returns. And when I say good returns, I'm talking about returns which are unmatched by any other asset class. If you want to get good returns, you have to put in a lot of research. And when I say a lot of research, it is not focused only on one particular method. It has to be multi-dimensional. It has to be taking too many methods into consideration. Yeah, sometimes it is like you have to give more weightage to one method, because as per method X, maybe stock A is better, and as per method Y, stock B is better. But then you have to give more weightage of, you should have certain methods which are more of a preference for you as compared to other methods. Like I personally like price to book value, price to earning ratio, as compared to price to cash flows or price to sales. I would prefer these two. Now these are relative valuations which I'm going to teach you today. Okay, so the whole idea of this is, the entire curriculum that we are doing is, I'm slowly and steadily introducing large number of factors which are going to help me do evaluation of a stock. As we keep proceeding with the study sessions, of time will come when I will start introducing external factors which are not stock oriented but are market oriented, or macroeconomic factors like crude oil prices, currency impact. All those things will also be incorporated in our discussions. So there is a way to go, and I'm so happy with just 25% of course completion. The kind of research which you are already doing at your level, most of you are doing, I'm really happy with that, really happy. And we have a way to go. We have a way to go from here, and learning is endless. We are going to do hell a lot of research work. Okay, by the time we finish off with the course, you plus me together, the number of stocks that we will talk about is going to definitely cross 150 such stocks, where you are going to look at their pricing and all those things. So this is something which should be taken in a very positive spirit, and this is your opportunity to learn. It's an asset for you. Think of it as an asset for yourself, because this is going long way. If not for anybody else, at least for yourself, you're going to make a lot of money from money, provided you apply your brains, you merge the methods. That also art I will teach you. Diversification of money, everything, each and everything I'm going to teach you in this curriculum. Okay, so start with relative valuation. If you see this study session, it starts like this. It involves valuation based on comparison with other stocks belonging to the same sector. Now, same sector means you can't compare SpiceJet, which belongs to an aviation sector, with Grasim, right? Which is in the cement industry. So similarly, you can't compare between SBI belonging to the banking sector with, say, Lupin, which belongs to the pharma sector. So when you're comparing, when you're doing relative valuation, do it between stocks belonging to the same sector. Okay, so The first measure is price to earning ratio, P ratio. This is a widely used method, P ratio. What is P ratio? Very simple. How much price company is charging for its share as compared to the earnings it is able to generate. So if P ratio for a stock is 10 times, okay, 10 times, it means for every 1 rupee of earning, that is 1 rupee of EPS that company is able to generate, it is charging a price of 10 rupees. So suppose if there is a EPS of the share is 15 rupees, which means the stock should be selling close to 150 rupees wrong. Okay. How do I know what P ratio should I be willing to pay for the share? You have to again do relative valuation. So suppose if I am talking about ITC, which is a FMCG stock, I'll compare the ITC PE ratio maybe with Dabur, Nestle, Britannia. These are the companies, HUL, these are the companies with which I would prefer to compare the PE ratio of Nestle, ITC, these companies, I'll compare their P ratio, right? So when I compare the P ratio, obviously first thing that comes to your mind is I should always pay a lower price for every 1 rupee of earning. That's the theoretical understanding. Okay? Lower P ratio is better. Let's first continue with this understanding. Lower P ratio is better. Why? Because for every 1 rupee of earning, if I pay less, it means stock becomes underpriced for me and I would like to buy that stock. Then we give a buy recommendation. If I only go by P ratio. Now of relative valuation, what I personally keep saying to my clients and to my students is, you have to understand one thing. Relative valuation, none of the measures are complete in itself. You have to use more than one method for doing valuation. You can't just look at P ratio, see the one stock which has the least P ratio and you give a buy recommendation on that. You can't do that. I'll tell you after some time why. So what is P ratio? If you look at the definition first, we've given it is the price investor has to pay for every 1 rupee of earning company is able to generate. Suppose if the P ratio for a stock is 14 times, it means for every 1 rupee of earning, okay, I think there's some, for every 1 rupee of earning, we have to pay. You can just do one thing, that I think some content is missing over there. So if P ratio, I'm just reading it out for you, you can just make a note of it. So suppose if P ratio for a particular stock is 14 times, it means for every 1 rupee of earning, we have to pay 14 rupees. Okay, please complete that. I'm sorry for the inconvenience. We have to pay 14 rupees. You can just complete it. Okay, for every 1 rupee of earning, we have to pay 14 rupees. Okay, obviously we want to pay less and hence we will start hunting for stocks which have lower P ratio. Basic level, you feel that this is good. Low P ratio stocks are better. So look at the first sum. All this data I picked up from the Money Control website. All this is reliable information. We are dealing with the real information. Okay. Or we first pick up the pharma stocks. Aurobindo Pharma has a P of around 20. Divis Lab has 33. Dr. Reddy's 70 P ratio. So their earnings are not justifying the price. That's why the P ratio is 70, which means for every 1 rupee of earning, you are paying 70 rupees. Glenmark is 16.5, Lupin is 30.3. For close your eyes, tell me which one is best. You will say, sir, we should buy Glenmark as first preference and then Aurobindo Pharma, right? This is what you will say. Obviously, yes. If I go only by P ratio, then obviously, if all these stocks are fundamentally good, obviously they all are fundamentally good. I generally take only fundamentally good stocks in my analysis, okay? So the stocks which are not fundamentally good, they don't have good earnings, their management issues are going on. We don't even look at those stocks. Come on, there are more than 5,000 stocks listed in India. We don't even have time to look at stocks which are fundamentally not good. Forget about them. Check them out. Okay, so we look at these stocks and we find that Glenmark seems to be well placed right now. Aurobindo Pharma comes second. Then comes Lupin. Probably Dr. Reddy, nobody will be willing to buy. Now, this is where my contradiction comes in. Please understand this. Obviously, in this case, Reddy appears to be very expensive. And in fact, Divis Lab 2 is expensive because again, Divis Lab has a 33 P ratio. Lupin seems to be correctly priced. Okay, somewhere in between. And then if I have to pick up the stocks from pharma sector, I would probably go for the ones which are really trading cheap. And I'll go for Aurobindo Pharma or Glenmark. But please understand one thing. Do you understand this? Why for a normal American diamond, right? American diamond, why would people pay less for that? And why would people pay more for pure diamond, right? So I hope you're understanding what I'm trying to say. So you pay price for quality, right? This is another aspect. This is another way of looking at P ratios. So what I'm saying is, if people are paying 70 rupees for Reddy, for every 1 rupee of earning, there has to be something good about Reddy, right? There has to be something good about Dr. Reddy, or for that matter, there has to be something good about Divis Lab, right? Where the P ratio is around 33. So we don't always look at it like this, that stocks with lower P ratio are better. Maybe they have a low P ratio because they don't have demand in the market. That's another angle of looking at it. So if a stock has a high P ratio, you just rule out the investment in that particular stock is not a good idea. Now, I'll give you my practical experience. Today only I posted it on Facebook also. We made people buy Dr. Reddy. We also made people buy Aurobindo Pharma. We also made people buy Glenmark. We also made people buy Lupin. But we also made people buy Dr. Reddy, even after being so highly priced, going by P ratio. Because I look at other things as well. Okay, one such thing which I look at is the 52-week high and 52-week low price of a stock. If the stock is close to its 52-week low, I personally don't see much downside risk, and probably I will make my clients buy that share. Hope you are understanding what I'm saying. Okay. So if the stock is trading close to its 52-week low, like you pick up the data of Reddy, if you look at 52 weeks high, the stock was trading close to 3,500 rupees. From 3,500, it has come down to 2,000 rupees, and that is its 52 weeks low price, close to 52 weeks low, which means a correction of already 1,500 odd bucks have happened in Dr. Reddy. Even with a very high P ratio, I would still prefer my clients to buy Dr. Reddy because the correction has happened to a very large extent. I've written that part in the remarks also. P ratio analysis is not as simple as it appears. What is simple? Simple is just see whichever has a lower P ratio, you buy that stock. It does not work like that. If that is the case, people will never buy real diamonds. They will only buy American diamonds because American diamonds are much cheaper and still give you the feel of having a diamond with you, right? So you are willing to pay a higher price because you're getting brand, you're getting quality, right? So you can look at it like that also. I'll give you another example, but let me first finish off with the remarks part. P ratio analysis is not as simple as it appears. We cannot rule out the fact that many investors are willing to pay a higher price, maybe because the stock is fundamentally very sound. For instance, Reddy 1 year back was trading at 52-week high of 3,500, close to 3,500. Today it is as low as 2,250. So it looks a very attractive buy, even though it is having a high P ratio. Why, sir? Because it has corrected a lot. Okay, so you just can't go by P ratio. You have to understand. If you read the books, there are a lot of books which say low P ratio stocks are better. Why? Because they are underpriced. No. In real life, you have to do a lot of more analysis than just looking at P ratio of a stock. Okay. Look at the second example. Consider data from auto sector. So Ashok Leyland is trading at a P ratio of 25, Bajaj Auto 20, Hero Motor 19, and once again M&M is 25. Again, if you go only by only by the P ratio, first preference will be Hero Motor and then Bajaj Auto. Okay, but if you again dig it in a little further, it's not that people will not invest money in M&M just because it has a higher P ratio. Okay, we have made people buy hell a lot of quantity of M&M. If you ask me reasons for that, you have to look at many other things. Okay, so that's what I'm trying to tell you, that the art is to see other components also. Like if I talk about auto sector especially, I've already given this example earlier. I will go